Equity is a fundamental concept in finance, representing ownership interest in an asset. Let's break down what it actually means for your portfolio. At its simplest, equity is the value that would be returned to a company's shareholders if all assets were liquidated and debts were paid. You can calculate equity by taking the total value of what you own and subtracting what you owe. It is your net financial stake. Equity comes with both potential rewards and specific risks. Understanding this balance is key to evaluating any company or property. Unlike debt, where you act as a lender, equity makes you a partial owner. This changes how you interact with the asset's success. Historically, equity assets like stocks have offered higher potential returns than cash or bonds, but they also come with significantly higher volatility. Remember that equity is rarely a short-term game. It usually requires patience as the underlying business grows or matures over many years. Equity is a powerful tool for building wealth. Please do your own research before making investment decisions. Subscribe for more financial basics.